rising unemployment rate, and an interest rate highest it has ever been in more than 2 decades. But still, house prices do not show any sign of slowing down, and instead, they are breaking their own records every year. But wait a minute, many people are like, Adi, this is not how it works. When interest rate increases, it becomes more difficult to borrow, more expensive to borrow. Then house prices start to go down and markets correct themselves. That's how the measure should work. But in Canada, this is not how it's happening exactly. So what is happening in the Canadian real estate market and in the housing market in particular? So I've got the facts, I've got the figures, I've got the reports, and I'm going to explain to you what is happening in the Canadian real estate market. To understand the housing market, we need to understand that the price of a property is determined by two factors: market demand and the market supply. The demand for housing is determined by the population, by the size of the population. And when we look at the population of Canada, it is growing at a very, very fast rate. Statistics Canada says Canada's population grew at almost twice the pace of other G7 countries from 2016 to 2021. So Canada's population grew faster than that of France, Germany, Italy, Japan, the United Kingdom, and the United States. This is crazy because we already know that the United States and Germany are already welcome thousands and thousands of immigrants on a yearly basis. So Canada beats them by a big margin. According to Statistics Canada, Canada is home to almost 37 million people, 1.8 million people more than in 2016. Most of the increase occurred prior to the pandemic, with Canada's population rising by a record high of 583,000 people in 2019. Immigration, not fertility, drove Canada's population growth from 2016 to 2021. So just in 1 year, right? Just in 1 year, in 2019, Canada's population grew by 500,000 people. Okay. So now you must be wondering, but what is the situation during and post-pandemic? So again, Statistics Canada says while the pandemic slowed the movement of people around the world, immigration still contributed to Canada's population by 0.4% in 2020, the fastest pace of growth in G7 for similar periods. So even, during COVID-19, during pandemic, there were lockdowns across the world, the flight movement, there were flight and movement restrictions due to strict COVID-19 policies, but still people were determined to come to Canada, right? So now you must be wondering, what is the future outlook for Canada? How does immigration in Canada look like? Well, put in short words, Canada wants more. They want more immigrants in the next 3 to 5 years. In fact, they plan to welcome 1.45 million immigrants till 2025. I mean, that's a big number. 2022 alone, so last year, they broke the record in terms of the highest number of immigrants. They brought in 431,645 new permanent residents alone. Okay, now if you take into account the international students, people on work permit holders, and others, the number is more than 1 million just in 2022. So you can see the transition from 2019, 500,000 to more than 1 million in 2022. Okay, and all of this contribute to higher demand for real estate, for properties, because of course, when you're an immigrant, when any person comes in, they want a roof over their head. So whether it's renting or actually buying a property, the demand is increasing. Now let's focus, why are so many people coming to Canada? Number one reason is Canada's an immigrant-friendly country, right? people are coming to Canada as much easier to get permanent residency and eventually citizenship. There are multiple pathways to immigration. To name a few, we have the express entry, family sponsorship, provincial nominees, and the list goes on. So it's much easier to get a permanent residency and even citizenship in Canada than in UK or the US, who are equally English speakers in the G7. The next reason why is people are fleeing wars. Okay, so recently we had the Russia-Ukraine war, and Canada accommodated more than 160,585 Ukrainian nationals. And another reason can be instability. For example, we have the Sudan conflict and calamities such as the Turkish-Syria earthquake. So all these things, basically people want to come to Canada because it's a safe and immigrant-friendly country. So in search of a better life, better job opportunities, safer environment, clean environment, people come to Canada, and as a result, this is putting pressure on the market demand. The demand is increasing, but at a very fast pace. Now let's look at the supply. What's happening with the supply of housing in Canada? So the first factor influencing supply is the high interest rate. Higher interest rate means that the prime rate is going to rise too. Now you must be wondering, what is the prime rate? So the prime rate is basically the interest rate that the banks will charge to their clients with the best credit. So let's say you have a credit of 750, you benefit from the prime rate. However, now there are many clients that do not have a good credit history. So these people will be paying even higher for their interest payments. So currently, the prime rate that the big 6 Canadian banks are offering is 7.2%, right? So now just imagine, real estate is actually, it's a debt-based industry. Developers or builders, they take heavy loans to finance the fancy skyscrapers, the condos that you see in downtown Toronto, in Montreal and Vancouver, across Canada, in the cities mainly, and even the houses. They are debt. It's basically debt in this. So in 2019, the prime rate was 3.95%. Prior to that, that was even lower, meaning that it was it was basically a giant party for the real estate companies. Capital was plentiful. Banks were giving out loans as if they were candy. Deal makings were at an all-time high. Competition for deals. Real estate companies were fighting for deals. Then what was happening? Then the price of the assets of real estate was very high. Now what's happening? Now the banks are not offering candy anymore. The rate has increased by 3.25%. Now interest rates are too high. Interest payments are too high. The real estate companies are hesitant to indebt themselves. Surging interest rates is making also the deals more expensive. They are more hesitant to make a deal. Developers are just saying, you know what, let's pause things. Things are changing so quickly. We are not panicking, we're just pausing. Let's pause our developments for now. But just imagine those high-end condos which could inhabit so many people, those houses, okay, those skyscrapers that could inhabit so many offices, they are all being paused, meaning that supply is not increasing. A recent survey done by PwC identifies interest rates and cost of capital as the top economic issue for real estate in 2023. That's the highest in terms of their concerns. That's what is keeping them hesitant to make deals, to build more, causing a problem in the supply. Okay, so now what is happening? We saw a significant rise in the respondents saying that both equity capital and debt capital is undersupplied. Okay, so what is equity capital? Equity capital is just money received from selling shares. Okay, debt capital is money received from borrowing. So not only does that affect the debt capital, but companies don't want to buy your shares. Companies do not want to buy your shares. And as a result, the price of the shares is falling too. So that's basically how interest rates is impacting our real estate sector. That's how the Bank of Canada has the power to control so much. The second factor is that institutional investors do not want to invest in real estate in that time period. Institutional investors, for example, BlackRock, Vanguard, they're seeing that they're not getting the same return, just like they were getting in 2019 from the real estate companies. So what they are doing is pulling their money from those real estate companies and giving it to which they think better bets, for example, artificial intelligence, electric mobility, and others. During this period of uncertainty, some investors are even turning to fixed income assets. For example, the bonds. Some investors, for example, family offices are like, hey mate, I've seen what's going on with Silicon Valley Bank. Still very risky during this period of uncertainty. I don't want to take this kind of risks, so I'm just going to keep it plain simple cash in my bank account. Because of the high interest rate, it makes sense why they're keeping in the bank account. They're getting a better return. So unfortunately for our real estate companies, they are dealing with a lack of funds from the investors. So as a result, less funds from investors means less projects they can develop, means that the supply will not increase as much as they would have increased in 2019. The third factor is rising costs. Unfortunately, it's getting more expensive to build in 2023. You have the labor shortages and on top the supply constraints. All of this is making it more difficult and expensive to build and develop more real estate. In fact, Ontario Chamber of Commerce, also known as the OCC, states that raw material shortages, including resin is a component used to make plastics, and polymer, contributing to higher prices and posing challenges for the ability to manufacture certain goods. Rotating power outages in some countries, for example China, prohibiting factories from producing goods at full capacity. Let's take the example of steel. We import a lot of steel from China, and China is by far the biggest producer of steel in the world. China is responsible for 53.9% of global production of steel. So if China is suffering from any kind of outages, it's definitely going to have an impact on supply across the world. Statistics Canada says the cost to build a house was 22.6% higher in the first quarter of 2022. For a residential property, costs were up 12.8% during the same period. So basically, it's cheaper to build a non-residential property in 2002 compared to a residential property. And when it comes to labor costs, Statistics Canada says construction job vacancies reached a record high in the first quarter of 2022. It was double the number of vacancies for the same period. Consequently, the wages were up by 6.6%. So for big real estate developers, that is an insane figure. Again, high labor costs and supply chain issues are not helping the already suffering real estate sector. And just think about it in the next 5 years. Shortage of labor is not going to get any better. Technologies in every other industry is advancing at a very fast rate. When you look at finance, retail, manufacturing, technology is an essential part in those sectors. And the technology in those sectors is advancing at an extremely rapid pace. Now compare it to the real estate sector. Construction technologies, unfortunately, are not advancing at the same pace. Another factor affecting real estate is ESG. It is a term we were not hearing too much in the past. However, over time, the influence of ESG is growing, not only in real estate sector, but also in different sectors. So in the next video, we're going to discuss everything you need to know about ESG and how is it affecting the real estate sector. If you enjoyed this video, give it a like and subscribe to my channel. I post finance content every Sunday. On this note, ciao.